I just want to talk more globally about the earnings picture. I've got a great chart for you here which shows a global disconnect. Basically, you've got the MSCI World Index blended forward 12-month EPS estimates. I said I wouldn't say that entire phrase, but I just have, and nailed it. And the MSCI World Index lagging there. Yeah. What does this chart tell you?
Well, you're exactly right. So I think so far this year, if you're looking at forward earnings, 12-month forward earnings are up about 11%. Now, the US is the big chunk of that, obviously. So they've expectations have risen by 16%, but global ex-US has risen 7%. So what you found, and if you look at that in the context of EM and European, underperformance so far this year in absolute terms, and that's what that chart tells so clearly, there's been a significant derating across the world. Now, in Europe and EM's case, two of our favourite areas, these were coming from already inexpensive levels in a sense. So it suggests that if some of the fears that are doing the rounds don't materialise, this is a very interesting buying opportunity. So what people are doing, is, like you say, is that they're moving beyond what's happening in the current, which is earnings expectations are rising, and generally the reports coming in are good, and they're moving beyond that to say, well, look, the trade war is going to trash all of this and so on. So if the trade war doesn't materialise, then it's going to be an attractive buying opportunity, you would have thought.
So essentially, have investors been focusing too much on the trade war, the prospect of it, at the expense of actually looking at the fundamentals?
Well, it's a very difficult thing to price, I think.
Yeah.
And this is one of the difficult things, is that, generally economists have turned around and done a very sort of simple sort of arithmetic kind of assumption and sort of said, OK, well, if you put this much imports on that much tariff on that much import, this is what it does to global GDP. But the problem is that standard economic models are obviously find it very difficult to account for uncertainty and the effects that has on investment, and also trying to work out what it does to various supply chains and so on. It's very difficult, and to that extent, maybe, and because of the amount of headlines the tariff war grabs, it's a very interesting story. That may mean that it gets exaggerated in our minds relative to the actual fundamental impact and the likelihood of it actually occurring. And so our mind would be still to tune out the trade war to whatever extent. We think eventually, hopefully, that sort of economic and political self-interest likely force a de-escalation, and that probably means that these fundamentals will shine through, and that really is quite an interesting thing for stock investors.
Yeah, we've already talked about the fact that you're long tech, you're constructive on banks, but you also like industrials. Why?
Again, it's that cyclical story.
Right.
And actually, in the US versus UK versus Europe, you found that US industrials have done a lot worse in recent times relative to European industrials. But still, there's an opportunity there. And especially if you're looking at that, and again, we go back to that story of the investment stories picking up. You've had that pent-up investment all the way up until middle of 2016, and then it starts to pick up. And where's that investment going to? Where's the capital expenditure going to? It should be going to kind of industrials, tech, those kind of areas should be the primary kind of revenue beneficiaries. So those are really, it's just really keeping that kind of pro-cyclical slant within portfolios as much as possible, because we can't see the next recession on the horizon just yet. And that means you've still got to invest in a way that shows that growth is continuing.
Yeah, and to bring that back to the EM point then as well, because we were talking about the fundamentals, and this might be a time to sort of get in as well. What asset classes in particular do you like in EM? Is it across the board, or do you prefer equities, or...?
So they tend to be reasonably correlated. So the same kind of factors explain performance, whether you look at credit, stocks, FX. But at the moment, we're focused still on the equity story. It's the valuation kicker that we think gives it a little bit extra. You've got very strong earnings growth coming through in the region, and that should mean that stocks are the place to do it. We would do it unhedged in a sense, so that gives you the FX kicker as well. Those two things tend to be pretty well correlated. But we're leaning towards EM Asia, which you do automatically if you just take an index bet. But we would lean even further. We'd do Korea, Taiwan, offshore China, and that's the areas that look most interesting to us in the context of what's going on in the world at the moment.
Yeah. What about Turkey?
Turkey is a difficult one, I guess, Nera. I mean, the problem you've got right now is that sort of worries about the central bank independence story have obviously continued. You have law changes which have given the president more power in this area. You've had changes to his economic team, which again has got us worried, or got everyone worried really, about what you're going to see in terms of central bank policy. And the big thing, obviously, is that we just can't rely long term on politicians to make the right decisions at the right time, the painful decisions at the right time, because it's just not in their interest if your incentives are wrong. And so that's why people are worried about the US, and that's why particularly people still worry about Turkey. And you've got the gathering lingering effects of the lira sell-off in the first half, and you should have a tougher second half in the Turkish economy anyway. This is not an area we'd be singling out for investment risk right now.
Yeah, so just because of the uncertainty, you would just stay away rather than looking for an opportunity to get in, say, on lira weakness or on any signs, say, from the central bank if there's a bit of a turnaround with an emergency rate hike?
So there's some areas where, certainly the more nimble investors are looking at parts of bank credit maybe, and so on and so on. For us, you've got to be nimble. I think the main thing that sort of we like about Asia relative to the rest of EM really is, you've got deep and liquid markets, you've got better diversification, and you've got strong macroeconomic credibility, in terms of policy making, so on. Your institutional context is just stronger and more plausible. And I think if you contrast that to parts of South America, Turkey, and the fragile trio, I guess, the trembling trio of South Africa, Turkey, and Argentina, those areas really show what it means to have stronger institutions. The old institutional economics idea, that actually your economies tend to grow faster and more reliably if you have stable rule of law, all those kind of things that we look for in that area. And unfortunately, Turkey is lacking in that part.
Will, this is something you'll be familiar with as well in terms of looking globally and where to put your money. So US small cap stocks, basically, this has been the trade to sort of kind of prepare for a potential trade war, I suppose. Money going into US small caps, coming out of emerging markets. Is this a little bit overdone if you take a look at this ratio now?
It's difficult, isn't it? Because there's all sorts of factors that go into it. If you look at the US economy right now, it's clearly humming. You had an already healthy economic backdrop, and onto that you've loaded a kind of fiscal logs onto a fire that doesn't really need it. And so it is. There's no doubt that it's humming. And one of the best ways to play that, so people argue, would be your kind of domestically focused small cap arena. The problem, I guess, with trying to play the trade war this way is trying to work out proportionally, your supply chain effects are so difficult to categorize and to predict in terms of how and what and where it falls to and who's going to have the real troubles with the cost structure. But I guess in a simplistic way, yes, it does work. EM should struggle a little bit more. But our best bet is really that you're going to try and look through this and try not to trade it too aggressively. It's a very difficult thing to trade, I think, accurately, the trade war.
Will Hobbs, Head of Investment Strategy at Barclays Investment Solutions, thank you so much.